what silver is at today. Haven't looked yet.
It was 83.5 last time I looked.
83.97 I show right now, up 571, and gold at 5,081.50, up 110 bucks. At 84 bucks, I mean, we were at 65 on Friday night. So here we are, you know, what, that's over 30% right back. I think what people need to understand is, you know, first of all, the CME group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. Yeah, I guess it's just a frosting on top of the BU or the uncirculated, the BU coins that we sell. The commercial strike, I guess, just don't have this frosting, which is nearly impossible to discern between the two. In essence, it's lipstick on a pig, and there's no reason to buy the uncirculated coin from the U.S. Mint, because the brilliant uncirculated coins, uncirculated being the U in BU, that you're getting from any dealer like myself, is just a better value. I guess if you're collecting it as part of a set, where you're collecting the proof and the uncirculated coin as issued by the mint, one set or whatever each year, fine. But again, anything that you're buying from the mint is not really economical from the standpoint of building your core position. It's more along the lines of things that you want to collect, and most of those things won't return their value. Some of them will, I guess. Some of them are made in very small quantities, and maybe they will, but certainly that's kind of the sprinkles and the hot fudge on top of the vanilla ice cream, which would be just the normal commercial strike, where you're getting more content rather than frosting, so to speak. I mean, I don't see that anywhere. I haven't heard about that. And look, one of the reasons we left our company in Minnesota, our corporate office, is, even though I'm in Florida, where we've had this satellite office for 15 years, I could have moved it out of Minnesota, out of the craziness there, and saved money, but I left it there because we're held to a higher standard through licensing, bonding, continuing education, compliance, and this has not been brought to my attention anywhere, and I've looked for it and can't find it. Now, there are several of these Asian guy channels. The one that I follow that I think has the best information, at least so far, again, I haven't followed all of them, but the OG John AG, the original John AG, he's one I follow. He didn't say this. It was someone else. I don't know. I can't see it anywhere. It's created nothing but anxiety, and I can't even figure out why they would have said it, other than maybe try to get people to sell before, before this mandatory reporting comes in. But to my understanding, to my own research, to everything my compliance department has told me, there is no such law that has been placed, and it's, for whatever reason, misinformation as far as I can tell. A certain number of bars in aggregate in one transaction that would satisfy a COMEX contract. 5 1,000-ounce silver bars, 3 gold kilos, or 1 100-ounce gold bar in one transaction, which is the definition in both cases of a COMEX deliverable contract. So anything other than that, no reporting. Yeah, you know, I'm just looking to see what silver is at today. Haven't looked yet.
It was 83.5 last time I looked.
83.97 I show right now, up 571, and gold at 5,081.50, up 110 bucks. At 84 bucks, I mean, we were at 65 on Friday night. So here we are, you know, what, that's over 30% right back. I think what people need to understand is, you know, first of all, the CME group raised margins to all-time highs. Raising margins is, first of all, people think it's very bearish. In my mind, it's not bearish. It's the exchange telling you that this move is real and it's getting violent. It's bearish at first because the amount of money needed to hedge positions increases exponentially. They've raised it twice right around Christmas, a few days before and the day after. It was like $18,000 to hedge 5,000 ounces of silver right around Christmas time. The day after, it went to 27,000 ounces, and now we're above $53,000, $54,000, $55,000 to hedge 5,000 ounces for a company like ours that would normally have 2 million ounces of silver in the warehouse. Becomes very expensive. You better have $50 million in your margin account, or you're not going to keep much in the way of hedged inventory of gold and silver. But this is also true of speculators. And, the margins are a percentage of the contract's value. So when gold and silver go up, the contract gets bigger and the margin requirement goes up automatically. That's a new thing. It used to be a fixed rate. Now they're making it a percentage. So, the math does this as the price goes higher. Okay, that's fine, but they're also adding volatility into the equation. And when the market starts getting swinging, like we're seeing up 30, down 30, they can raise the percentage that you need on margin. And that's when it really bites. And because now you're getting squeezed from both sides, higher prices and higher margin rates. But here's why it's bullish. And to me, it's bullish because margin hikes don't stop physical demand. What they stop is paper leverage. And they force the weak hands out. And they reduce the ability to run giant positions just on thin collateral, where you can control massive positions by having a small margin account. And so, yes, you will get a paper flush when this is implemented, like we saw. And futures can and did drop when the leveraged traders are forced to liquidate. But that's not the end of the bull market. That's the shakeout. And the people that have been standing for delivery, as I've been really screaming about for quite some time now, for 15 straight months, so they're not using margin. And so these are the big money, the banks. Could it have been a one last attempt to bail out some of these U.S. banks who still had? Now, we've been talking about the Commitment of Traders report that said the U.S. banks are net long. We've talked about the report that came out of the Economic Times that said the banks are net long. But being net long doesn't mean you're long only. That means you have more long than you do short. Now, could this massive price rise and all of this attention that we've been seeing on silver precipitate some concerns by some very big players in a coordinated fashion? They raise margins and smack the crap out of it? Yes. But what they really did was they chased leverage out of gold and silver. And when you do that, you don't make those that are holding said metal weaker. In my opinion, you're putting it into stronger hands. And so, that's kind of the tell to me. And margin hikes don't end bull markets in metals. In my mind, they usually mark the point where the next leg higher becomes inevitable because now it's in strong hands and the price is now moving up. I want to give you a kind of what I mean by that too. So this is kind of one of the moments where the market confesses. And you had the biggest one-day drop in silver maybe ever. And everyone got emotional. People are screaming and panic and, they assume demand vanished. But this is how these idiots work, okay? The very next day, SLV takes in the largest one-day metal inflow in years. Dunnigan, that's not panic buying. That's institutional metal transferring at a discounted price. And what I mean by that is that you had 550 million shares outstanding the day before it dropped. The day after, it goes to 587 million. So that's a 36.3 million new shares that were created at roughly 0.905 ounces per share. That's about 33 million ounces of silver added in one day. And the authorized participants are the only one who can create those shares, and they can only do so by delivering physical metal first. So think about really what that means. Silver gets smashed, and immediately after the smash, tens of millions of ounces show up inside the ETF. This tells you that someone with A real balance sheet used the forced liquidation, this margin event, to source physical metal cheap and park it where they control it. And they control it inside of the ETFs. And this is metal migrating from forced sellers to the institutional vaults, because these institutionals can do what's called share redemption, and they can redeem their shares if you're an authorized participant in metal, and it's far more opaque than it is transparent. And it's just another mechanism they have to drain physical metal out of the ecosystem. But when you line up the delivery pressure that we're seeing, the tightness in the registered inventories, which I want to talk about in a moment, all of this stuff, including what's going on in the ETFs, this is not normal flow. That's inventory reshuffling under what I think is major stress. And, Richard Russell used to say something like this to me. He used to say that markets don't reveal themselves during the violence. They only reveal themselves after. And where price is the weapon, freaks everyone out, but the inventory is the confession. The confession is we really don't have it, but we need to freak everyone out by flushing them out with price and margin increases. But nothing has changed. In fact, now you get into this Project Vault that's come up where you got the U.S. government that is acting very much like silver is not plentiful. It's acting like it's strategic. Of course, they call it a strategic metal right now. We've had 6 straight years of a deficit, of course. It's been added to the critical mineral list, but now you got this Project Vault, a brand new U.S. critical mineral reserve. It's obvious that they're worried about disruptions, and they call it a public-private structure designed to stockpile essential raw materials inside the United States to protect supply chains. That means they want to incentivize domestic mining also. So you put a floor under the price, and then you zoom out, you look at COMEX registered as the delivery pile, which is massively lower than a few years ago, and the LBMA is being bled dry. Demand is rising, supply is constrained, and the world is treating silver like it's a strategic input. They're admitting this right now. And so I think that, when governments start stockpiling, the message is simple. The scramble for the real stuff has begun. And if that's really what they're going to do, you better clean up your balance sheets if you're wickedly short. Maybe that's what this was about. But I can tell you that nothing changed. There are no fundamentals that changed at all. In fact, maybe they're even getting stronger. And what I mean by that, last thing, and I'll take any questions that you have, the March silver contract is really shaping up to be really interesting. Right now, the March silver contract open interest, meaning contracts that could stand for delivery, is between 80 million and 81 million, right around 80,500,000 contracts open interest.